Hi, I'm Anthony Andelin, the Chief Operations Officer at Bedrock Investment Property, and today we want to help discuss the rules of a 1031 exchange. This is one of the things that Bedrock specializes in, is helping investors take existing rental properties and transition through the 1031 exchange guidelines and rules into better income producing real estate. This is something that we've done dozens and dozens and dozens of times and helped clients reacquire hundreds and hundreds of properties through 1031 exchanges. We're experts at understanding these rules and how to apply them to your situation. Today we want to walk you through these rules and help you better understand the process of a 1031 exchange. We know why we set them up. The purpose of a 1031 exchange is to take the capital gain that's been created in a home that you already own. If we sell it, we incur the taxable event, right? And in some cases, we can be dealing with 20, 25, 30, 40% in taxes. The 1031 exchange allows us to take that tax basis that we have in that property and reinvest it into other properties, deferring that tax. Now that's one thing to make sure you're really clear on. We cannot eliminate the previous capital gains tax from a property. The 1031 exchange allows us to defer it. And so if I have one property right now with a tax basis of, let's just say $100,000 in, and I do a 1031 exchange and I take that tax basis and it goes into 3 houses, I now have that tax basis of $100,000 spread over 3 houses, a third in each home. That capital gain still needs to be accounted for at some point in time. The tool of a 1031 exchange is just to defer that to the future. Now we can keep doing this indefinitely until you pass away. And if you've looked at our legal video that we talked about with our estate planning, one of the rules that we have in real estate is the step-up and basis law, which allows us then to pass on real estate at passing to heirs or beneficiaries where they receive it at the current market value, eliminating all previous capital gains tax. Wonderful tool to help reduce the taxes that we can pay on the assets that we're acquiring in our finances right now. So as we look at this, the first thing I want to walk you through is how to calculate your capital gain. Now, as we look at the formula for this, we take the sales price of the current property that you're listing or selling. Now, we have to minus from that the original purchase price of a home, and then we have to add to it any depreciation that we've written off over the years. It's called recapturing depreciation. Now, this rule is how we calculate your capital gain. So if I have a property of a primary residence, and if I've lived in it 2 of the last 5 years, I don't have to pay capital gain. But under that situation, if I had a home that I sold for $200,000 that I bought for $150,000, my gain is $50,000. Okay? If I had a $200,000 home that I'm selling that I acquired for $150,000 and had 2 years of depreciation at $5,000 a year, my gain now is $200,000 minus $150,000, so a $50,000 gain, plus depreciation of $10,000, which would be $60,000 of gain. Now, it doesn't mean you're paying taxes or $60,000 in taxes. What it means is your tax rates are then applicable to that gain. Okay? If we do a 1031 exchange, I'm taking that gain and then reinvesting it into other properties, deferring that tax. One note of depreciation again, depreciation does not apply to your primary residence. Okay? Depreciation only applies to non-owner occupied properties. So if you've lived in that house for the last 5 years as a primary residence, depreciation is not applicable, and a 1031 exchange might not make sense. We'll get to that in the like-kind exchange rule here in a minute. If it's an investment property you've owned, a 1031 exchange might make sense. We get the full repurchasing power of the equity in that home, and we can defer that tax to a later date. Now again, I'm not a tax professional, but I want to walk you through, at least on a federal level, the tax brackets for capital gains. If you are a single file person on your taxes, and you make less than $39,375 per year, your capital gain could be 0. As a joint file on your taxes, that amount increases to $78,750. So if you've earned less than that on your capital gain, right, you might not have any taxes to pay. If your income level is $39,376 to $434,550, so this is where most people in America are going to fall On a single file, that's 15%. The same 15% on a joint file is about $78,751 to $4,888,000. So as you're looking at that, most of you are going to fall under a 15% federal capital gain tax rate. When you're looking at your state taxes, again, some states are going to be higher than others. In California, you might be 9 to 13%. In Utah, you might be 5%. In Florida, you might be 0%. But also in the Affordable Care Act legislation, there's designated for 3.8% tax on capital gain that's cited with the Affordable Care Act. So in total, some of you might be looking at 23, 25, 30% in potential capital gains taxes between state and federal. Again, I'm not a tax professional. Verify those numbers with a tax professional in your state and your jurisdiction that might be more accurate in projecting your potential tax implications on the sale of a home. Now, as we're looking at the rules of an exchange, the first rule we get into is what's called a like-kind exchange. Now, this is where we're looking at saying if I have an investment property, a non-owner occupied property, I can transition that into another investment property. If I have raw land, that can be transitioned into an investment property, non-owner occupied property. If I have commercial properties, that can also be transitioned into other investment properties. What is not a like-kind exchange is going from a primary residence to an investment, or going from an investment property to a primary residence. Those are not like-kind exchanges. So as we're doing a 1031 exchange, we do have to make sure that what you have and potentially what you're moving into can be considered like-kind. That's our first rule that we need to follow. Second is that the property or properties that we're going to acquire after we sell a property has to be equal or greater value to what you just sold. Okay? So if the selling price of my existing home is $400,000, I need to replace it with at least $400,000 of equity or more in new purchase prices on my new acquisitions. That can be done in one property. It can be done in 5 properties, right? So as long as we meet equal or greater value from what you just sold to what you just acquired, now we're still following and compliant with the rules of our 1031 exchange. Debt financing rule. If I have a $500,000 home that I sell, and I have a mortgage still of $300,000 on that house, I have to replace it on my new acquisitions with at least $300,000 of debt financing. Or I have to be able to bring outside cash into the exchange at the value of the amount of financing or debt that I still have on the property. Now, when you're looking at this, even if you're selling a property, and we're going to go through an example here in a minute of a client that sold $1 million piece of real estate in California, and we transitioned that into 6 houses. I usually say, even if your goal is to own free and clear real estate, as I'm looking at your real estate blueprint plan, one of my general rules for clients is if we have a free and clear property, that we buy free and clear properties with the equity to keep it similar in terms of the status in your portfolio. But as we're doing a 1031 exchange, to make sure that we're always either one, meeting the debt financing rule or exceeding the purchase price rule of greater or equal value, we might need to finance one property just to make the numbers work to satisfy the 1031 exchange. So as we're talking about your details of your plan and your existing home and what can be done with it, don't be surprised that we reference maybe financing one property, even just to make the numbers work, to make sure that tax basis is deferred. Our next rule is this. We have from the date of closing on the property you sell, we have a 45-day window to identify the new property or properties that you wish to purchase. Now, what does identification mean? Well, as you're working with your exchange company and your title companies, again, the proceeds of the sale when you close are held in escrow. Identification is there's a form that we fill out that lists the potential addresses that you might want to purchase. Okay, that's what identification means, is that we submit within 45 days to the exchange and title company the potential addresses you want to target. But here's the downside to that. If their homes are not officially under contract, and even though I've listed them on my form, if somebody else buys that house and puts it under contract, it is now taken off my list. I don't have that option anymore. And that can put in jeopardy your exchange. So at Bedrock, our modified rule of this is 45-day identification window is we want you under contract on all new purchases within the 45-day window. And that way, when we fill out that form and submit it to the exchange and title companies, we know for a fact that you're going to be able to purchase those properties because you already have them under contract. Okay? So make sure you're clear on that designation of what identification means. It's just identifying potential addresses to purchase. We'd rather make sure we're safe knowing that those homes are already under contract. Our next rule is from the date of closing on the property you're exiting, you have a 180-day window to acquire all of the properties that you wish to repurchase, okay, or as part of your exchange. So we close, we have 6 months then to purchase and close out the properties that we've identified, okay? Now, if we're doing cash purchases, those can close within a couple days to a couple weeks after closing. If we're financing transactions, and again, depending on how we're pre-qualified to work with the lender, we might need to stagger that up. We've had exchanges with clients that we've used up to the very last day of this window in closing properties. We've also had exchanges where we've closed all of the new purchases and still had months to spare. So again, we are very much aware of these deadlines as we work through your 1031 exchange scenario to make sure that we keep this compliant, because the last thing we want you to do is to set up your 1031 exchange, not complete it properly, and now have to pay potential capital gains tax on that transaction. Let me walk you through an actual scenario with one of our clients. We have a client in the Bay Area who purchased a condo. It was a small 1,000 square foot home, 2-bedroom, 1-bath, built in 1930. Okay, she bought this home in 1981 for $39,000, and when she sold it end of last year, she sold it for $1,050,000. So her appreciation in owning this asset for almost 39 years was just over $1 million of gain. It was an investment property and had been fully depreciated. Remember, as we sell a house, our capital gain is the sales price minus our original purchase price plus recapturing the depreciation. And so as we looked at her selling this condo for $1,050,000, she bought it for $39,000, right? Her gain in terms of capital gain was $1,011,000 on this condo. Her tax basis, based off her income in California and federal taxes, was over $300,000 in potential taxes. She was never going to sell this property. And being in her retirement years, she was counting on the $18,000 a year of net income that this property was yielding for her to even get by and live. So she met us. We showed her what was possible with this house. And what we ended up doing is we bought 6 houses with the same amount of equity in her one. We bought them in Tennessee and in Florida. And we bought them for $215,000 cash, $160,000 home cash, $147,000 cash property, $188,000 cash, $165,000 cash purchase. And then we financed one home at $235,000 purchase price. Again, this house was free and clear, and we took the equity and we put it into mostly free and clear properties. But to make the numbers work, we still financed one property. As we look at what happened, she sold her house for $1,050,000, which means our greater or equal to greater value rule means we have to replace it with at least $1,050,000 of real estate. Her combined purchases totaled $1,110,400. Okay, so we exceeded what she sold to what she reacquired. The home that she had was paid off at the time of sale, so her amount financed was $0. But to make the numbers work, we financed one property, and so her new debt financing rule was $188,000 on her new portfolio. Again, it just has to be equal or greater to what we just exited. Okay, her net cash flow on the portfolio that she had on this property was $18,000 a year of net income. We were able to find 6 houses, put them all under contract in 45 days, close all of them within 120 days. Remember, we have 180 days of closing to purchase our homes. We did it in 120 days. And her net cash flow increased from $18,000 a year to $55,000 a year. And the amount of taxes owed on the 1031 exchange right now is 0 because instead of being in one unit, it was deferred into 6. And because of our step up in basis law, as long as she keeps those homes in her name or connected to her before she passes, she can leave those to her heirs and they can inherit it at the current market value, eliminating all previous capital gains tax. This is an example of what we can do for you. It doesn't have to be $1 million property. It could be a $100,000 property. It could be a $500,000 property. It could be homes that you have a lot of debt financing on and we want to replace that. The purpose of a 1031 exchange in our minds is to take an underperforming piece of real estate and reallocate that equity into better performing real estate for you. We are experts in this field in helping clients transact successfully 1031 exchanges. If this is meaningful to you, go to www.bedrockinvestmentproperty.com or give us a call at 833-255-0055 and we can help create a customized blueprint report of your existing real estate, analyze its performance, show you what's possible with our cash flowing properties, and see if a 1031 exchange makes sense for you. Thank you.